Hi everyone, and a very warm welcome. It's great to have you all here with us for the launch of the Landscape of Climate Finance for Agri-Food Systems 2025. The report was published just yesterday, and it's now available on the Climate Shot Investor Coalition or CLIC and CPO websites. My name is Harsha Vishnu Malakala. I'm an analyst with the CLIC Knowledge Pro team, and I'm here with my co-authors Leah Fosho and Jide Olotoke to walk through some of the key insights from this year's report. So the format for this session is quite straightforward. We'll kick off with a short presentation, followed by some time for Q&A. And you can submit your questions at any point using the Q&A box at the bottom of your screen. We'll do our best to address them after the presentation's over. And just a heads up, the session is being recorded and will be made on the CLIC and CPO websites in the next few days. So for those of you unfamiliar with the Agri-Food Landscape series, this report brings together the latest data and trends on how climate finance is flowing to agri-food systems globally. The report highlights where progress is being made and where it's being stalled. And more importantly, it points to opportunities we have now to accelerate climate action through smarter policies, stronger local institutions, and better collaboration across public and private stakeholders. While it's true that there's been positive momentum around agri-food systems in recent years, they remain significantly underfunded when you compare them with their mitigation and adaptation potential. And we will show this in the session later today. In today's constrained funding environment, the urgency to close this funding gap and to demonstrate innovation, bold leadership, and alignment to do more with less is greater than ever. So before we get started and get into the details, I want to thank you again for being part of this conversation. So with that, let's jump in. So here's the agenda for today. We'll first set the scene on why agri-food systems matter for climate, people, and nature. Then we'll walk you through what's new in this year's report compared to the previous edition, and then we'll dive into the headline findings and our recommendations. We'll then leave around some ample time for Q&A, so around 20 minutes. But yeah, with all that being said, I'll pass over to Leah to touch on the background.
Thank you, Harsha. I'm very pleased to be here today with you all. My name is Leah. I'm an analyst at CPI to give a brief overview of the background. So our report focuses on agri-food systems. So the scope is broader than the traditional AFOLU sector, standing for agriculture, forestry, and land use. So agri-food systems cover both food and non-food products through the entire value chain from production to waste. So this includes the intermediary steps between the upstream and the downstream part of processing, distribution, and consumption. So the scope of agri-food systems is very vast, and for this very reason, they have a profound influence on both people and the planet. Agri-food systems are responsible for 30% of global GHG emissions. I'm always very struck by this figure, but they are also a primary driver of biodiversity loss. Many species are at risk of extinction because of agri-food systems activities. And another aspect to keep in mind is that over 1 billion of people are reliant on agri-food systems for their livelihoods. So having said that, agri-food systems are very important to deliver various sustainability goals, so climate action, food security, but also inclusive growth. And I had it over to Jide now.
Yeah, thank you very much, Leah. So before diving into our headline findings, here's a quick overview of what's new in this year's edition of the Landscape. This report offers the most comprehensive picture to date of global climate finance to agri-food systems, which is now covering 2019 to 2022. It tracks finance by sources, climate objectives, the sector, the region, as well as the financial instruments, and as well aligns closely with the methodology that was created by CPI flagship publication, which is the Global Landscape of Climate Finance. So compared to our first edition, this year's report goes deeper in a few important ways. The first thing is we've made effort to address gaps in our climate finance tracking, particularly around domestic public finance. For this edition, we've actually taken a closer look at some major domestic subsidy programs to improve visibility where data has historically been limited or underreported. Secondly, and we actually built on our collaboration with the FAO last year through the Triple Gap report. We've also developed a comprehensive set of investment needs estimates for agri-food systems, and these align with the 1.5C pathway. These estimates are referenced throughout the report, And it's not just to quantify the overall funding gap, but more so to identify where actions is most urgently needed. And finally, we've expanded our sectoral coverage. So this year, we actually included biodiversity, land, and marine ecosystem. This also builds off our work with the FAO last year to develop a more comprehensive taxonomy of agri-food system solutions. And this allows us to better capture ecosystem-based approaches that contribute to resilience, productivity, and climate outcomes. So I will hand it over to Harsha to take us through the headline findings.
Thanks, Jide. So with that context, let's move on to the headline findings. So let's look at the big picture. Between 2019-2020 and 2021-2022, the share of global climate finance agri-food systems doubled. So this went from 3.6% to now 7.2%. And if we're talking about financial volume, what this translates to is more than a 300% increase. Now, it's important to note here that this growth is coming from a low base, and investment needs far outweigh the flows that we currently see. And I'll touch on this a bit later in the next few slides. But despite that, the growth is an encouraging signal, and it shows growing recognition of the sector's importance. However, when we look just beneath the surface of this growth, we see that this growth is far from even. In fact, it's highly concentrated in just a few regions. One of the key drivers that we identified in this growth was the rise in domestic finance. So domestic finance as a share has expanded from nearly half to 3/4 of total agri-food climate finance between these two periods. But, and this is critical, 90% of the domestic finance that we see comes from just two regions, China and Europe. So to help put their influence into perspective, if we include China and Europe, our data shows a 300% increase in global agri-food funding, as mentioned. But if we exclude China and Europe, the growth dramatically drops to just 62%. In China, the growth we see is largely due to investments in agrivoltaics, which can be due to many factors, but largely attributed to the country's 14th five-year plan, which prioritizes rural revitalization. And in Europe, what we see is the increase reflects the momentum from the European Green Deal and post-COVID-19 recovery measures, which prioritize green investments, especially in agri-food systems. What I find particularly striking about these numbers is that they demonstrate the power of strong policy mandates to drive agri-food transformation. But then outside of China and Europe, the growth has been far more modest. So if we look at agrarian economies in sub-Saharan Africa, South Asia, and Latin America, they continue to receive a disproportionately small share of climate finance, as we've seen in the previous report. So while the global totals are rising, it doesn't necessarily reflect the broader and systemic shift that we need to see in the space. The truth is, we remain far from where we need to be. To align agri-food systems with a 1.5-degree pathway, the sector requires an estimated $1.1 trillion annually through 2030. So that's 12 times the current level of investment. I should acknowledge here that 1.5 degrees is often seen as an increasingly difficult target to meet. And in fact, 2024 was the first year we crossed this threshold. But for the sake of this analysis, we use 1.5 degrees as a practical benchmark, a clear reference point to understand the scale and the depth of transformation that is needed to align agri-food systems with climate goals. To put the scale of agri-food climate finance into perspective, it's probably helpful to compare it with the other major sectors that we track. So in 2021-2022, agri-food systems received 5 times less than energy systems and 3 times less than transport. Now, what this graphic essentially is here to show is that agri-food systems receive a disproportionately small share when we compare it to their environmental impact. As Leah mentioned, agri-food systems contribute 1/3 of global greenhouse gas emissions and have much more of a great impact on livelihoods and nature and biodiversity. So there is a disproportionate allocation of finance here given its impact. But beyond the scale of climate investment, it's also important to look at how existing capital is being deployed within space, just more generally. As you can see on screen here at the top, approximately $570 billion in public agricultural support is classified as having a high to moderate risk of environmental harm. And if we look at private institutions, they have over $6 billion in active financing. What these figures show is that the problem isn't necessarily just a lack of capital, it's that a substantial share of capital that is being deployed is deeply misaligned with climate and nature goals. So while it's important to raise new capital to help fund the agri-food transformation, repurposing existing finance may be one of the most immediate and powerful levers for achieving the same. I'll now pass over to Leah to talk about public sources.
Thank you, Harsha. So now I'm gonna give an overview of the sources of finance. So looking at the distribution of the types of actors in agri-food systems. So public actors remain dominant. They contributed to $74 billion in 2021-2022, representing almost 80% of the total flows in agri-food systems finance. These flows represents a 3 times increase compared to 2019-20, and the growth was driven by domestic investments, mostly from governments, national development banks, and state-owned enterprises. And this is particularly true in China and Europe because they benefit from favorable policy environments. They have indeed scaled up investments in areas like agrivoltaics and green bonds as well. But it's interesting to see that if we exclude these regions, we clearly see that multilateral DFIs play a critical role in international finance, especially in supporting Sub-Saharan Africa and Latin America. Their contributions almost doubled, and they reach $10 billion, as you can see on the graph on the left, on the right, sorry. So these DFIs finance solutions that contributed both to mitigation and adaptation. For instance, activities such as sustainable livelihoods, sustainable livestock, and climate resilient crop production. But there is an important point to flag here is that domestic finance grew faster than international finance. So for the regions who rely on international public finance, it's particularly concerning. Latest research shows that 2/3 of agri-food climate finance needs are linked to external funding. So there's a growing risk of disparities in accessing finance between the different regions of the world to make our food systems more sustainable. Now moving on to private finance. So private actors contributed to $19 billion in 2021-2022. And this represents roughly 20% of climate finance to agri-food systems. There has been a strong growth, 6 times bigger, and this growth has been driven by major markets mostly, with investment opportunities in China, Japan, and Europe, especially in agrivoltaics and biomass projects. So these projects target mitigation. In contrast, if we look at adaptation and smallholder focused solutions, especially in developing countries, the finance that goes into these solutions is still limited. Adaptation is often perceived as higher risk, and this partly explains the low figures here in private finance participation. But it's important to flag that we are facing data gaps in adaptation finance from private actors, and this prevents us from providing a comprehensive picture of private finance to adaptation in agri-food systems. And adding to this, there is a limited visibility of the investment pipeline that continues to reinforce the misconception that there are few private sector opportunities in adaptation. So if we don't address these barriers, we will continue to miss a critical opportunity in supporting broader agri-food transformation and building climate resilience. Just a small point to add on that slide as well is that philanthropies are relatively small actors. They contributed to $1 billion, as you can see on the graph on the right, but they still remain key in providing concessional capital and help scale the financing of adaptation projects. So now we're gonna dive into the climate finance uses, starting with mitigation finance. So we mentioned that agri-food systems are a big emitter of greenhouse gas emissions, but they only received less than 4% of global mitigation finance, as you can see on the left side of the graph. What does this figure tell us? It tells us that there is a big opportunity to finance mitigation solutions in agri-food systems because agri-food systems hold a strong mitigation potential. And between the two timeframes, mitigation finance almost tripled, reaching $45 billion. Public actors provided the majority of this finance, around 75%, mostly through national GFIs and state-owned enterprises. And the flows were mostly directed to crop and livestock systems, which overall receives the largest share of finance. And we'll deeper dive later into that aspect. So a significant portion of the funding in agri-food mitigation finance goes to energy-linked solutions, such as agrivoltaics and biomass. In comparison, core agricultural activities, so more on the upstream side of the value chain, receive less financing, but they still hold a strong mitigation potential. So these activities, for instance, include sustainable cropping, forest protection, or soil health improvements. And there are also other aspects of agri-food systems that can unlock strong mitigation potential. So it's more on the demand side. For instance, dietary shifts or reducing food waste. But these solutions attracted minimal investments, less than $500 million in 2021-2022. So to scale up investments in mitigation in agri-food systems, we need more of blended finance, public-private partnerships, and a better integration of mitigation into national strategies. Now moving on to adaptation. Adaptation finance in agri-food systems attracted $13 billion. This accounts for 20% of global adaptation finance. So flows have increased, which is a good signal. There has been an increase of 77%. But despite this progress, the volumes remain far below what is needed. And adaptation also continues to be heavily financed by public actors, making up 85% of the flows. This finance was mostly disbursed through grants and concessional loans from governments and DFIs. Now looking a little bit at the regional split, Sub-Saharan Africa received 29%, which is the largest share, reflecting its high vulnerability, but there are other key agrarian regions, such as Latin America and South Asia, for which the funding remains limited, despite facing urgent investment needs. So there are a couple of options to scale up adaptation finance, and they need to be combined. So we have de-risking mechanisms, better pipeline visibility, improved data and matrix, but also a stronger engagement of local financial institutions. And now I'm gonna detail a little bit finance, so dual benefit finance. Flows that contribute both to mitigation and adaptation. And in the case of agri-food systems, these portion of the flows are is quite important. Agri-food systems reached $37 billion when it comes to dual benefit finance, and this marks a six-fold increase compared to 2019-20. So agri-food systems are the largest recipient of dual benefit finance across all sectors. Why this is the case? Agri-food systems don't work in silos. They benefit mitigation, adaptation, nature, people at the same time for most of the solutions. For instance, agroforestry or climate resilient seeds. Moreover, public actors, particularly governments, they contributed 62% of dual benefit finance in agri-food systems, particularly through use of proceeds bonds. But we have limited information about the exact projects which are financed through these bonds because of data limitation, sorry. We just know that they support upstream activities, so core agricultural, forestry, and fisheries activities. when we look at private actors, commercial financial institutions supported $5 billion and were the first actor, and they were followed by corporates with $2 billion. So it's very important to improve data quality and transparency, specifically in the case of dual benefit finance. And that will be key in scaling up what solutions works and unlock the full potential of the multi-benefits of agri-food systems. I'll now hand it over to my colleague Jite for the rest of the findings.
Yeah, thank you very much, Leah. So beyond climate use and sources of finance, we also analyze the flows on sectoral and regional level. On a sectoral basis, even though there is an overall growth, agri-food climate finance still remains well below estimated needs. The crop and livestock sectors receive the largest share, somewhere around 41% of total finance, but much of that was driven by energy-related projects. I mean, as mentioned earlier, like the Chinese agrivoltaics and the Japanese biomass projects. When you strip out the energy component, what's left for ag-specific mitigation and adaptation projects is actually quite limited. To stay on track for climate goals, annual investments in these core ag sectors, such as soil carbon and agroforestry, they need to actually increase by at least 8 to 9-fold. Also, forestry, fisheries, and aquaculture, they all received around 11%. But again, much of this went to energy-focused projects. For core climate smart practices like forest restoration and sustainable fish production, they still remain underfunded. And in this case, we believe that they require stronger policy support as well as concessional finance to drive investments in this sector. I want to quickly highlight that the fisheries and aquaculture sector is still an emerging area for climate finance. So we're talking of limited data. And then there's a possibility that the estimated needs that you're seeing right now is actually quite understated. Also, the food and diet sector received just around 0.4%, even though it has high potential to reduce emissions through dietary shifts, as well as food loss reduction. This same goes for the policy capacity building and national budget support, which continue to receive minimal funding, even though this particular sector is actually really critical to enabling long-term system-wide change. So, as finally mentioned in the previous slide by Leah, nearly 1/3 of finance is still marked as unspecified. This has limited us in some ways to analyze which sectors and solutions are actually being supported. So when we looked at regional distribution, we saw a big disparities in finance flows, and Harsha actually mentioned this earlier, so I'm going to go deeper into this a little bit. East Asia and the Pacific received 46% of the total flows. Interestingly, I mean, maybe not interestingly, China alone accounted for 86% of this. And this is coming through domestic investments in the agrivoltaics and rural development. And this is largely driven by their 14th five-year plan. And going back to what Asha mentioned earlier, this really shows how strong policy direction and public domestic investments can drive climate finance at scale. This is quite missing in a lot of regions where we need to see investments growing. Finance for sub-Saharan Africa grew to $7.8 billion, with nearly half of these going to adaptation projects. However, most of this is still coming from grants and concessional loans. Even though we're seeing a rising commitment, it also means that this region is still reliant on public funding. And this highlights the need to build stronger investment pipelines, as well as deploying de-risking tools that can crowd in more private capital. In Latin America and the Caribbean, we actually saw domestic flows quadrupling, with big contributions from the national and regional development banks. However, total volumes still remains quite modest in comparison to what the region actually needs. What this all points to is that there is a need for region-specific strategies, even more so given the current global political context. We need approaches that build policy coherence in this region, that deepens the local capital market, and then that can channel influence towards regions that are actually most in need. And finally, we looked at the type of instrument that is being used to channel agri-food climate finance. Debt instrument remains the dominant instrument, making up almost 62% of total flows. And this goes up from 47% in our last report. This was largely driven by market rate lending, especially targeting dual benefit projects in crops, livestock, and forestry. We also saw a rise in equity financing. This goes up to 20%. And Chinese state-owned enterprises actually played a big role here. They financed agrivoltaic using their own balance sheets. And as well, grants funding as well increased in volume, but its overall share fell to somewhere around 18%. This shift in instruments shows a more diversified finance landscape, which is what we've been asking for, but it also reinforces that we need a more strategic blend. First, grants and concessional capital, they are still essential for high-impact early-stage solutions, particularly for adaptation, smallholder resilience, and other areas that don't actually offer immediate returns, especially in regions that they might not be able to mobilize private capital as fast as they should. Secondly, equity is still an important part that is necessary for sharing risk and supporting innovation. And we're talking of projects around scaling hard SMEs in newer business models. And lastly, blended finance tools like guarantees and insurance, they are very key to unlocking private capital in high risk or underserved markets. So ultimately for us, it's not just about mobilizing more finance, it's about getting the right kind of finance to the right places in a ways that could actually align with both climate and development needs. So handing over to Harshad for the rest of the presentation.
Thanks, Shide. So yeah, now that context of kind of current finance flows, let's move over to the recommendations from the report. So the barriers that limit agri-food finance aren't just challenges, they're signposts for where targeted interventions can drive real system-wide change. So that's why our report highlights 8 action areas, as you can see on the right here, which range from improving financial access for smallholders and agri-SMEs to strengthening data systems and disclosure frameworks. What we see these as are like practical levers where targeted investments and policy reforms can really shift the needle. Just because of time, I don't think we can really walk through each area and act specific recommendations, but let's focus our attention to the key principles or enabling conditions, as we call them in the report, that we believe are critical for unlocking capital and delivering climate-aligned agri-food transformation. So as you can see on screen here, these enabling conditions are robust domestic public policy, strong local financial institutions, and then coordinated multi-stakeholder action. Let's unpack why these enabling conditions are so critical and how they translate into action. So first, robust domestic public policy, it sets the direction for investment. So in public subsidies, infrastructure, regulatory frameworks, all of these heavily influence where capital goes. And when these are misaligned with climate and nature goals, finance flows into business as usual. But smart policy interventions, such as redirecting harmful subsidies or embedding agri-food into NDCs and developing clear green taxonomies, can send strong market signals, lower investment risks, and create an attractive environment for both public and private finance. Second, strong local financial institutions. So these are very important to reach the last mile. Actors such as local banks, agri-lenders, and cooperatives, these actors understand smallholders and agri-SMEs the best, but often they lack the tools, the capacity, or the risk buffers to support climate-aligned investments. So interventions like tailored de-risking instruments, flexible loan products, or localized technical assistance hubs can be essential and empower these institutions to extend affordable finance to unserved actors and build resilience from the ground up. And third, coordinated multi-stakeholder action. We believe this is critical to overcome fragmented efforts. So agri-food systems, as we all know, involves a complex web of actors, including governments, DFIs, private investors, corporates, local communities, and without coordination between each of them, efforts siloed and opportunities to achieve scale can be missed. So, which is why we emphasize platforms for collaboration, shared data infrastructures, and joint financing mechanisms to help align incentives, foster trust, and unlock blended capital at scale. What's critical here is that these enabling conditions reinforce each other. Policy reforms can improve the bankability of projects, stronger local financial actors can channel finance to where it's needed most, and coordinated action can ensure that these efforts are aligned and scaled. So the report goes a bit further, offering targeted recommendations for each ACT group to help turn these conditions into real and system-wide transformation. So with that, I just want to say thank you, and we'll open up to some questions.